Today on Retire with Purpose, the many uses and benefits of life insurance, building Social Security's insecurity into your retirement plan, and making a good pension decision.
Welcome to Retire with Purpose, a show specifically designed to help you maximize your financial confidence in retirement. Casey Weed is the CEO and Chief Visionary of Howard Bailey Financial, a certified financial planner and Wall Street Journal best-selling author. He's your host on Retire with Purpose.
Hey, great to see you again. I am Lee Kelso here with Casey Weed, certified financial planner. He is also the president of Howard Bailey Financial and host of the Retire with Purpose podcast, one of the top podcasts in retirement and finance. Hope you'll check that out. But we're going to make that easy for you today because we're going to feature one of the guests that he recently had on the podcast talking about how life insurance today is much more than you might think it is.
Yeah, we're going to be speaking here with Jim Bowman, which has actually been a longtime friend of mine. And he's been in this industry his whole life. So he knows more about life insurance than any man that I know on this planet, and he brings a lot of value to the table in that realm. He is the president of life insurance operations at what is known as Advisors Excel. They are a field marketing organization. We're going to talk about what that means to you here in just a moment. And he has helped turn them into one of the largest life insurance independent distribution channels in the world. And first off, in our conversation, we cover what life insurance is, because sometimes I think we've gotten it misconstrued what life insurance really is, and it's evolved a lot over the years. Life insurance today is much different than it was 50 years ago, even 5 or 10 years ago. It continues to evolve just like technology does. So we kicked off our conversation with that question: what is life insurance?
Well, first of all, life insurance is an asset first and foremost for the protection of a loved one, right? You buy life insurance at the core because you want to have somebody you love have a quality of life if you're not there. So that's why the tax code, which is going to be very important in the actual discussion of life insurance, the tax code says if you pay a premium, you get a tax-free benefit to the beneficiaries. No income taxes, no capital gains taxes. And that's what people mostly think of. But there's another part of the tax code that says, listen, if you put money in excess of the cost of insurance and fees to manage the policy, you can put that into I'll call it a bucket today. You can put it into a bucket, and that can grow tax deferred. And I'll take it a step further. It can also be withdrawn without paying any capital gains taxes on that, because you're going to borrow your own money. As long as you do it properly, you can actually use this as a supplemental retirement tool.
And life insurance has become a key element of our financial plan as a family. Everyone needs life insurance, but everyone needs a different type of life insurance for different reasons. We use a significant amount of life insurance that we have, not just for risk management, but also for tax-free income in the future and even long-term care and disability. And that's one of the elements that has greatly changed in the long-term care and the life insurance world, is that there are many policies out there, like the ones that I own and many of the families we work with that own, where you can use the death benefit while you're alive for long-term care purposes. And there's pros and cons to doing that. So I wanted to hear from Jim what his thoughts were on why we might choose traditional long-term care insurance over life insurance as a solution.
You know, I for the life of me, the only reason they would do this is they weren't informed on other opportunities. Because when I was in the corporate world, I ran an insurance company's distribution, and we had a long-term care division. And it made me sick when we had to raise a client's premium 40%, 50% on an annual bill for a husband and wife. That was meaningful. It impacted their retirement, and it just it drove me nuts. So we actually got out of the business. We made a decision in corporate to say we weren't going to offer individual long-term care. I like this approach so much better because the client can decide how much coverage they want to take on, how much of the risk do they want to cover, and it's all, they know the numbers. There's not worried about a new bill coming next year. So to answer your question, I think if clients truly understood their options, I don't think they'd take the individual option at all.
Well, I'm sure you're already aware of the traditional use of life insurance. You pass away and it protects your heirs from the loss of income, the liability risk that you face in passing away, and how that's passed on to your heirs is protected through life insurance. You might also be aware that you can use it for tax-free income. Now we've discussed how you can use it as a long-term care solution. And then there's one more use that we also own a couple of policies ourselves for, and that is for cash management. Right now, interest rates at the bank are next to zero. So where can you put your cash in order to generate a higher rate of return, maintain security, and also the liquidity that the bank offers? Well, I'll let Jim cover with you how life insurance can be used as a cash alternative.
The one you're talking about is only offered by two companies to get to the value for the consumer. But what we typically see is a client that's been sitting in cash. They like having cash. It's been sitting in a money market or a CDs, maybe even a bond, where it's sitting there. There's real no purpose of the money because you're not getting a lot of return. I mean, I don't know I think Bank of America, where I bank, I think 0.3, 0.4 return, on my money sitting in a money market. And add a little salt to the wound, and then I got to pay taxes on a little amount that I got interest on. So it's really not providing any value other than it's a safe place. So if I said to you, I can put you in a contract that is going to give you some meaningful growth opportunity, 4 to 6%. It'll be tax deferred. If you pass away, we'll double it for your loved ones, tax-free. If you can't do 2 or 6 ADLs, I'm going to give you, $150,000 off my $100,000 example of chronic illness protection. Aren't I giving you a lot more value than what the bank's giving you on a taxable, but they're giving you safety. And by the way, and they're giving you liquidity. But also I'll give you your money back. Now it's not ATM, you'll get it back within 30 days, 2 weeks. It's just not ATM liquid, but it gives so much more value.
You might also be wondering why you should care who Jim is. Well, Jim is basically an intermediary. So anytime you ever buy life insurance with an independent advisor, any type of financial planner, they can't go directly to the insurance carrier. There is an intermediary there, and it does matter who that intermediary is. It's a good question for you to ask, and I'll let Jim explain why that is.
I think it'd be good for a consumer to understand who's behind their advisor, their agent. Who are you working with? What's their credibility? And are they only locked into 4 companies or 5 companies? Are you getting the best advice and counsel as to in the marketplace? And I can give you a simple example. We have a situation we're working on, and they want a significant amount of death benefit for a state tax plan. Well, we represent 45 companies. Not all 45 are good in that marketplace. There's probably about 12 that I would say, hey, this is the list you want to look at. But if somebody's got only a support of 7 or 8 companies behind them, you're not going to get the best opportunity. Now, they may have the best company at that market at that point in time. They may. Where with us, it's a no doubt. We're going to be able to provide that, the best product, the best pricing, the best underwriting decisions possible. So is the consumer going to ask that? Probably not, but should they know it? Yeah, they should.
Yeah, I guess there's a lot of change in the insurance industry, right? So I hope you'll check out podcast number 164 and learn more about how insurance can play a role in your retirement. And if you're curious about just how well you're positioned for retirement in general, take advantage of this opportunity. Be one of the next 10 callers and request a complimentary retirement review with a member of the Howard Bailey team to check just how well are you structured on insurance, but also on things like taxes, health care, a market downturn. What would happen in your retirement if all those things happen to you? Well, you can find out with a simple complimentary retirement review with a member of the Howard Bailey team. You can do it on the phone, on Zoom, or visit the office. Any way you like to do it, but be one of the next 10 callers at 866-482-9559 and plan a meeting with a member of the Howard Bailey team. One of those members is coming up next with Casey. It's Marshall Johnson. They're going to talk about the insecurity in the Social Security system and how you can plan for that.
Hi, Casey Weed, president of Howard Bailey Financial. Planning for a secure and independent retirement requires staying on top of the latest trends. New retirement regulations, trillion-dollar stimulus packages, and a pivotal election year all need to be taken into consideration. The Howard Bailey team is here to support you. We develop retirement plans driven by meaning and purpose, so you can stop worrying about what's next and focus on what means the most to you today. Call now for a complimentary consultation and a customized plan of action.
Welcome back to Retire with Purpose, and now we are joined by my good friend and co-host of the Retire with Purpose podcast and radio show. We have Marshall Johnson joining us now, and this is our opportunity to spotlight one of the 4 articles we send out every single Friday as part of our Weekend Reading for Retirees email series. So every single Friday, we send you 4 articles on trending topics in the retirement planning space, all designed to help you make better decisions about your retirement. You can sign up at retirewithpurpose.com. And while you're there, check out episode number 154 of the podcast, where we cover this article in depth. This one comes to us from Forbes. It is titled How to Build Social Security's Insecurity into Your Retirement Plan. So Marshall, why did we choose this article?
Hey, it's a great topic, right? It affects most Americans. We get a lot of questions about Social Security, but also it's written by a really good author, Steve Parrish. He's been a guest on our podcast. He takes a very academic approach. It's not a bias-filled article. This is a straight line. Give me the facts. How can I fix my retirement plan?
Well, and his podcast that we did was one of the top podcasts that
Right.
we have ever recorded and put out there, because he's a professor of finance and he had just transitioned into retirement.
Himself,
So
yeah.
you get to see how a professor of finance would build their very own retirement plan, and that's exactly what we were able to pull out of him. And he covers a lot of different topics in his writing, and that's how I was originally introduced to him, in addition to him being one of my professors over the years. And this one in particular talks about Social Security, the insecurity of Social Security. Social Security is always a huge topic of conversation with anyone that we work with that has yet to file for Social Security. And the insecurity of Social Security is usually at the top of that list. The concern with Social Security going broke. Will Social Security be there in the future? That's a major concern, and rightfully so.
Yeah, and it's a concern primarily because they put it right on your statement. If you read there closely, they say that the trust is not going to have the amount of funds necessary to pay 100% of what's owed by 2036. And now studies have come out. Wharton Penn has put out a study based upon COVID and the things that happen with our payrolls. They think the insecurity now is going to be 2034, 2032. So it could be 4 years even earlier, where we have to build this into our plans.
Yeah, 2032, 2034, 2036, nobody
somewhere.
knows when it is going to happen, but it will happen. But the important thing to note there is also that that doesn't mean there won't be any funds there to pay Social Security benefits. There will be income there to continue to pay a portion of those Social Security benefits. There may just be a reduction. However, keep in mind, this isn't the first time this has ever happened. This has happened in the past. And at the 11th hour, they've always made changes to make sure, especially those that are on Social Security, continue to receive their
It's that
benefits.
third rail of politics, right? You know, they don't want to touch it for fear of losing their constituents. So it's probably going to get fixed, but by fixed, that doesn't mean that everything's going to be guaranteed at the rate it's at. There may be a reduction in benefits, or maybe a raise in taxes, so you just have to understand what could be coming down the road.
Well, and the article talks about the importance of analyzing your Social Security to determine when the very best time is for you to maximize those benefits by filing at that particular time in that particular way. And it's important because of the value you're actually receiving. I think many times we take for granted how big of a decision this actually is. The average Social Security benefit's about $1,400 a month. Well, in order to generate $1,400 a month, you would have to have about $450,000 in after-tax dollars in order to generate that same type of income.
And not to mention, it's inflation adjusted, right? So to have inflation adjusted lifetime guaranteed income, That's a big deal, and that's really hard to get on the open market.
Well, and what's unique, I think, about this article is they talk about stress testing that Social Security strategy. You know, a lot of financial advisors, you've probably, if you're working with a financial advisor, you may have had a Monte Carlo simulation where they're stress testing that portfolio against different types of market returns. How well will your income strategy perform? If you're working with an advanced planner, they may be doing some tax stress testing. If taxes go up, what will be the impact on your overall retirement strategy? But I don't think there's nearly as many financial planners that are actually stress testing that Social Security strategy.
Yeah, you're trying to figure out what's going to happen if you do have a reduction in your benefits. How is that going to impact the rest of your plan? How's that going to impact your taxes? It's all a part of the discussion, and it's a meaningful one.
Yeah, they give some unique ideas on how to stress test that, different perspectives from different advisors. Everybody has their own perspective. One could be doing a 10% reduction in your benefits. Another one could be waiting to incorporate a deduction until, or a reduction until that point in time of which the Social Security Trust Fund is expected to be depleted. And in many circumstances, it's just using that stated dollar amount that you find on your statement.
Yeah, instead of using an inflation adjustment, let's just put in a flat $1,700 or $1,800 and assuming that, hey, if there is insecurity with the system, maybe we're not going to get those inflation adjusted payments.
Yeah, I think that's an important point, is to really figure out what the best Social Security inflation adjustment is going to be. What's that cost of living adjustment that makes the most sense? And age is a huge factor in this. Given that changes in Social Security that will incur here in the near future historically have been sunsetted, if you're already on Social Security, there shouldn't be much of a concern. It might make sense to go ahead and proceed with the Social Security you're already receiving and not build in some type of reduction. However, if you are a young individual, if you're in your 20s, if you're in your 30s, I say, hey, don't plan on Social Security being there.
Yeah, pretend like it's not going to be there. Prepare as if, right?
Yeah, and what's that mean? That means that you need to save more for retirement. That's never a bad thing. You get to save more for retirement. And having financial independence means not depending on anyone else. And that means you're not depending on some government entity doing a good job managing your finances. Do a good job on your own. And then when you get to retirement, hey, that'll be a bonus if Social Security is still there. And it will probably be different for those of you that are 20, 30 years out from your retirement date. Now, if you're in that 5 to 10 year window, that's when it really makes sense to pay attention and do some stress testing around Social Security. Absolutely, you want to do that, and you could be doing it in any number of ways. I really like doing the 10% reduction and reducing the cost of living adjustment.
Well, and it's a little bit emotional too. We've all got some bias. We all come from a personal bias, and we have to understand what our biases are. And some people say, well, hey, I'm not real healthy. I'm probably not going to live to full life expectancy. So they may want to start earlier and have a lower cost of living adjustment. Other families say, hey, my grandmother lived to 96 and my great-grandmother was 104, so maybe they want to defer to a later date. But it's running those examples and making yourself comfortable with that decision.
Well, and we're pumping out Social Security analysis day after day, all day long. It's very simple for us to do. If you'd like us to analyze your Social Security and show you when the best time is to file in order to maximize your benefit, we can do that complimentary, email it out to you, no cost, no obligation. However, keep in mind that just because it says you should file at 70 or 66, maybe you should do some type of different strategy if you're married, it doesn't mean that's going to be the best thing for you. Once you incorporate that into your broader financial plan, many times we will find that you should actually take Social Security earlier and you'll end up with more assets over the long run. Right now, we have a special offer. We have a Social Security guide that we have on hand that we would like to get out to you. If you're preparing to make this decision and you're trying to figure out, well, when is the best time to file? How does Social Security work? It breaks down all those things. And I think most importantly, it gives you some good questions you should be asking yourself and your financial advisor. In our next segment, I want you to stick around because we're going to be covering taxes, we're going to cover pensions, we're also going to cover what it means to have a fiduciary responsibility from your financial planner. We'll see you in a moment.
Hi, Casey Weed, president of Howard Bailey Financial. Planning for a secure and independent retirement requires staying on top of the latest trends. New retirement regulations, trillion-dollar stimulus packages, and a pivotal election year all need to be taken into consideration. The Howard Bailey team is here to support you. We develop retirement plans driven by meaning and purpose, so you can stop worrying about what's next and focus on what means the most to you today. Call now for a complimentary consultation and a customized plan of action.
It's time for Casey to get to work answering your questions. And if you have a question for Casey, it's really easy. Just go to retirewithpurpose.com, and in the lower right-hand corner of the page, look for a little window. Just drop your question there. It'll go to Casey, and we might ask you to join us on the program, as we did with Brett from all the way up in Plymouth, Minnesota.
If you withdraw funds from a universal life policy, are you required to pay them back, or does it just lower the death benefit?
Well, Brett, I'm just going to answer in general here. In general, when you take that withdrawal, you're just taking withdrawal of the cash. And the risk there is that now you might have to start putting more money back into that policy. Otherwise, it may collapse because the cash itself may have been funding the death benefit. If you take too much cash out, now you may end up with no death benefit left to your family at some point in the future. That is the risk with universal life insurance, is that you just mismanage it. And that's one of the benefits, too, of universal life insurance, is that it's so flexible. And in general, life insurance is just a complex beast. And it's very unique. Every single policy is so flexible that they're all unique. They can all be structured differently. Like we heard from the president of life insurance here just a moment ago, from Jim Bowman. He talked through all the different types of life insurance and how they can be structured as a cash alternative for tax-free income in the future, as just a death benefit for estate planning purposes, as a cash alternative. There's a lot of different uses. So I would really encourage you to get an analysis done. If you've already taken the withdrawal, have an in-force illustration done by the company. That will show you if it's going to continue to work and what that net death benefit will actually be to your heirs. And again, it's very flexible. And one of the things I love about universal life insurance, that is the only life insurance that I own, and I own several different universal life insurance policies, is that flexibility, but also some other benefits in relation to whole life insurance. We have a couple that have worked with us for a few years now. When they came over, they had some whole life insurance that they were planning on using for tax-free income in the future. They were also concerned about rising interest rates. They were going to start taking loans from that policy. If they took a loan from the policy, they could take it out tax-free, and then they would have a net death benefit still passing on to the heirs. So that is a really good core use of that life insurance, that whole life insurance, good strategy. However, there wasn't a cap on the loan interest rate. That's key. When you take a loan from that whole life insurance policy, those interest rates they're charging on that loan, there's no cap on those whole life policies. But with universal life, there's many companies that will offer a cap. So you know that you're never going to see that policy, in a sense, blow up. And so we were able to transfer them from that old whole life policy into a different type of universal policy where they would be able to take the same tax-free income, but with less risk, more income actually, and more death benefit that they can also use for long-term care. So if you own life insurance, get it analyzed, because things have changed and it's important to stay on top of those things.
Man, that's a major difference and distinction. Hey, let's get over to Benton Harbor, Michigan, and Kelly's question.
How can I take my pension in a lump sum and avoid getting killed on taxes?
That's a great question, Kelly, and one that many get wrong. They go, well, if I take my pension in a lump sum, they're offering me this lump sum, or they're offering me this lifetime income. I don't really want the lifetime income. Maybe you don't need the lifetime income, and you decide you want to take the lump sum, but you don't want to get killed on taxes. And many times, individuals will make the wrong decision and say, well, I'll just take the pension so I don't get killed on taxes. However, what you can do is you can roll it over, and you can roll that over to an IRA. So you can roll that over to an individual retirement account, and it stays completely tax deferred. You don't have to pay taxes on it to take the lump sum. You can roll it to an IRA, and we do this all the time because many of the pension options today just aren't as good as we can get in the private marketplace. So we can take that lump sum and get you more guaranteed income than you could get if you left it with that pension company itself. So we might be able to get you more income and more flexibility with the asset, being able to take excess withdrawals and have something that you can leave behind to your heirs. And in some cases, you should take the pension. And if you take the pension, you should evaluate all those different options. And you're doing this with a calculation known as an IRR, or an internal rate of return. You want to know what the actual rate of return is that you need in order to get the same results with that lump sum over taking that cash flow, over taking that pension payment year after year. Make sure your advisor is actually doing analysis and not just saying, oh, well, you got to take the lump sum and we got to roll it over, we can get you bigger returns. Yeah, I want to know the hard facts.
Let's get to an email question that came from Jeremy here in Fort Wayne. How do I know if my financial advisor is truly providing guidance that's best for my situation, or simply recommending products because of their profitability?
Yeah, well, I think the first key is find a fiduciary, someone that follows a true fiduciary responsibility, the legal responsibility to put your needs ahead of their own. That means that you're working with an investment advisor representative or a registered investment advisory firm. The vast majority of advisors are not following a fiduciary standard because they fall under a different standard. They are brokers and they don't have that responsibility to you. And that's the first stop. Find yourself a fiduciary and find someone that's following a planning process where things are being recommended because of your unique situation and how they fit into that process, and they have all the tools at their disposal. So when they present you with product A, you say, hey, where's product B, C, and D? And why would you choose A over these others? What do you get paid on these 4 different items? Ask them that question. You asked your car dealer how much the car was going to cost. Ask your financial advisor how much they're going to get paid.
Yeah, great advice. And everybody at Howard Bailey follows that fiduciary rule, and I think that's a good reason for you to be one of the next 10 callers and request a meeting with a member of the Howard Bailey team, either on the phone, by Zoom, or some way. Take a look at exactly what's going on in your retirement. How well are you positioned to handle taxes, a market crash, healthcare crises? A lot of the factors can come along and derail your retirement. You deserve an independent and secure retirement. So talk with a member of the Howard Bailey team and find out how you're doing and hear their thoughts. Fiduciary guidance at work at Howard Bailey's, you just heard. That's so important, and that's why I think you want to be one of the next 10 callers at 482-5995 and get a complimentary consultation with a member of the Howard Bailey team. It's all the time we have this week. We will see you next week right here on Retire with Purpose.
Hi, Casey Weed, president of Howard Bailey Financial. Planning for a secure and independent retirement requires staying on top of the latest trends. New retirement regulations, trillion-dollar stimulus packages, and a pivotal election year all need to be taken into consideration. The Howard Bailey team is here to support you. We develop retirement plans driven by meaning and purpose, so you can stop worrying about what's next and focus on what means the most to you today. Call now for a complimentary consultation and a customized plan of action.